You need to sell parabolic up charts because they resolve to the downside. I believe specifically, and I said this the last time you and I interviewed, that the dollar will likely lose 75% of its purchasing power over 10 years. Well, what they need to understand about uranium is that structurally, this is a market that cannot go wrong. I have found that too many people rely on news because it allows them to feel as opposed to think.
Makes sense. Most people watching can't come and vet 100 companies in person. So give them that home version a little bit. I mean, what are the 2 or 3 things that a regular investor should actually kind of check before they're buying a mining stock?
Well, you actually hit it inadvertently on the way in. The average investor should limit the number of stocks in their portfolio to the number of hours per month that they're willing to work studying companies. You're willing to work 30 hours, you can have 30 stocks. 10 hours, 10 stocks. For me, I have a staff. I have geologists, I have engineers, I have financial analysts, and I myself spend at least 40 hours a week studying. So I could own 160 stocks plus because I have a whole team that does it. Most people have lives. And for them, they need to constrict the number of stocks they have in their portfolio to the number of hours per month they're willing to work.
Now, right now, I mean, we just had, I think of Adrian Day just coming on the show. And I mean, he was buying some haircuts last week and he goes, oh, maybe I should have waited, but it's fine. So that long-term thesis is still there. Is this a buying opportunity now?
Absolutely.
Yeah.
Could it go lower? Yeah. Of course. Yeah. Bernard Baruch famously said, the only guy who bought at the bottom and sold at the top was a liar. It didn't happen.
We could talk about your own money because I think we talked about this at PDAC, but you made that big move. I mean, earlier this year, you sold something like 80% of your physical silver. You rotated into silver mining companies. Walk people through that process and whether it played out as you hoped.
The process went like this. I save in gold. Gold is not a speculative asset for me. It's a savings asset. Yes, I would sell it in the right circumstance, but we aren't close to that circumstance. Silver was different. It was a speculative asset. I bought physical silver because silver was hated. And I know that the easy money in cyclical businesses occurs if you have the guts to buy hate. When I bought silver, it was less than 20 bucks an ounce, and people hated it. And my thesis was that over time, that hatred would dissipate and the price of silver would rise. Well, that happened. Mm-hmm. And when it happened, I needed to decide if there was a new thesis that should keep me in silver or whether I should transfer my speculative capital from silver to something else. When I looked at it, I said, you thought that silver could go to 50. It didn't. It's 75. There's a parabolic up chart. You need to sell parabolic up charts because they resolve to the downside. Is there a better use of capital? Yes. 50% of the money went into silver stocks. Why silver stocks, not silver? Here it becomes arithmetic. If the silver price goes up, the silver stocks do well. If the silver trades sideways, by definition, you make no money. But the silver stocks were priced discounting $35 silver in a $75 market. So the silver price could fall and the silver stocks could still do well. If the silver price fell because of the discount in the silver stocks, arithmetically, the silver stocks would fall less than the silver. Same upside, better sideways, better downside.
What he just walked through isn't luck or timing. It's a repeatable framework. Buy what's hated, ride the move, then do the math on where the better risk-reward sits once the easy gains are gone. That's the kind of discipline most retail investors never actually apply, even when they know it in theory. If breakdowns like this are helping you think more like a professional allocator, hit subscribe and turn on notifications. We bring you conversations with veteran investors like this every single week.
Better speculation.
Now, you talked about gold is kind of a savings, and the gold miners still look cheap relative to the metal, obviously. But are you making the same move now in gold? I mean, are you selling a little bit of metal to buy the miners, or is that just a completely different call?
For me, I save in gold. And despite the fact that I don't need to, I save a lot. It helps me sleep nights and stay calm. All of the net profit from this conference will be invested in physical gold in my account. Placed, by the way, in Battle Bank. I save in gold. I maintain liquidity in US dollars. I invest in senior gold stocks and I speculate in junior gold stocks. Those are very different buckets.
Now, I know Battle Bank is here this year. I went and had a nice little conversation. You're getting closer and closer. People are getting excited about it. Is this kind of the next phase for you? I mean, you've been waiting for this for a while.
Well, this is my 7th bank. Many people might know that. It's my 2nd bank in the same incarnation of the same management team. Okay. So I'm hugely excited about it because I love banking. And I believe in community banks. Battle Bank is a community bank where community is defined by aspiration rather than by geography. Battle Bank is a bank designed around a community that you see here. It makes perfect sense that I would be involved in a bank for this community simply because I know my customer, and my customer acquisition cost is zero. I have a durable competitive advantage serving an audience that I've served for 50 years. And banking is a very good business if you don't make mistakes.
Difficult to get into.
All businesses are difficult. I've been in a lot of businesses in my life. I've been successful at most of them, but every business is difficult.
Now, you've described gold as kind of being in roughly, the third inning of a 9-inning kind of game. After this correction we just went through, where are we right now?
I think we're in the 6th inning. I believe the gold bull market, at least for me, the gold bull market began in the year 2000. I think we've got 10 years left. So we're in the 6th inning. Understand that in most financial markets, the best part of the move, the hyperbolic move, comes towards the end. I believe specifically, getting the baseball analogy aside, that gold will trade inversely to faith in the US dollar. Faith in the US dollar, because of nominal interest rates, is relatively high now. But the arithmetic around the US dollar is profoundly bad. I believe specifically, and I said this the last time you and I interviewed, that the dollar will likely lose 75% of its purchasing power over 10 years, which suggests that the gold price in nominal terms, US dollar quoted terms, could be a triple over 10 years. Not a bad move.
No, it's not. And it's not just gold and silver for you anymore, obviously. You've been putting real money into copper as well, and I want to talk about that because for someone who kind of only thinks about gold, make the big picture case, right? Why copper? Why now?
Well, copper is simple supply and demand. First of all, right now, we're using more copper than we produce. And you can only use more copper than you produce when you have surplus inventories. We're about 3 years away from being out of inventories. That's the way it works. At Metals Week in London last year, they presented a fantastic paper saying that to maintain current levels of copper production, understanding that they're in deficit, to maintain current levels, the 10 largest copper mining companies in the world have to invest $250 billion. Several problems with that. The first is they don't have the money. Yes, they can get it, but they don't have the money. The second is that you're maintaining production in an industry that's in deficit. The third problem is that copper demand is growing, so the deficit, assuming that you maintain production, is going to fall.
Notice how he frames this. He's not trying to time a top or a bottom. He's making a structural bet on currency debasement playing out over a decade. That's a very different mindset than most people bring to markets, and it's worth sitting with before we get into why he's making the same kind of structural bet on copper.
The money that we need to invest in copper now, in order to impact copper supply 5 years from now, needs to have been invested 15 years ago. You cannot make up for 20 or 30 years of systemic underinvestment in 5 years. Absent a depression, copper will be rationed by price.
You know, it's interesting. I turned on, just before coming down here, I think I turned on CNBC, at one point Bloomberg, just to see what the mainstream was talking about. And we got this NVIDIA crack right now with the AI trade. I mean, it shredded about $1 trillion since May. And now people are going, oh, maybe that's going to affect copper. Maybe there won't be a bullish trend. Is that the contrarian take that you kind of look for?
It's misinformed.
Yeah.
The baseline trend in copper is demographic. There are more people being born every day than are dying. There's more people on Earth. And the people on Earth, particularly in emerging and frontier markets, want to live like you do. A materially abundant life is an energy-intensive life. There's 1 billion people on this planet today that have no access to primary electricity. In 20 years, they're going to. It's going to take copper to generate that power. It's going to take copper to get that power to them. It's going to take copper for them to use it. Yes, AI is going to work. People ask me here at the conference, well, what do you think of NVIDIA? The truth is, I don't think of it at all. I can't spell it. I understand copper. I understand that there's been 30 years of underinvestment in copper. I don't have the sophistication to talk AI. And by the way, most of the people who invest in it don't either. I'm not panning it. I'm just trying to say that the copper market is easier to understand than the AI market.
Yeah, and you could say the same as well for uranium. I mean, you said it could be kind of one of the best places to be for the next decade. In plain terms, for our audience watching, I mean, what does a regular person need to understand about that?
Well, what they need to understand about uranium is that structurally, this is a market that cannot go wrong.
Right.
The easy money has been made. The easy money was been made by the people who bought uranium when it was hated. That's over. People don't hate it. A few things people need to know. The first is that uranium is the only source of baseload power that doesn't generate carbon. The second thing that people need to know is that politically, the world doesn't hate uranium anymore. 6 or 7 years ago, in my country, the United States, being a proponent of uranium, I thought my picture was going to be in the post office wall and not in pleasant terms. Now these morons want to subsidize me. The winds of change are all over the place. Technology favors uranium. Much more recently, the last uranium boom was heralded in 1973 by the Arab embargo, when people became concerned about energy security. We had a wake-up call 4 months ago in the Gulf. The Arab oil embargo caused the French nuclear fleet to be built, the fourth largest in the world. It caused the Japanese nuclear fleet to be built, the third largest in the world. For 50 years, we had a vacation from concerns about energy security. Now it's first and foremost on everybody's mind. Finally, the nature of the uranium market is going from a spot market to a term market, unlike any other commodity in the world. So a simple-minded securities analyst like Rick Rule can do forecasted prices and volume based on contract as opposed to supposition. Uranium will, over 10 years, be the easiest commodity to value of any commodity on the planet. These are structural changes. There's no rhetoric here, there's no narrative here, there's no emotion here. It's all arithmetic, and the arithmetic is all good.
You ever surprise you just watching, the winds change on a daily basis from an investor, even a younger generation? I mean, they can see a TikTok video now, they think, okay, nuclear maybe is greener.
Right.
It's interesting.
It's lovely to be 73 in that sense. Mostly it's not, but it's lovely to be 73 and understand the impact of change, and understand too the fact that change is not forecastable, but it's observable. Most of my competition's expectation of the future is set by their experience in the immediate past, and that's wrong. Most anticipation is...
Here's the common thread running through every one of these commodity calls. He's not betting on sentiment or headlines. He's betting on decades of underinvestment finally catching up with demand. Keep that lens in mind as we shift into how he's thinking about the current oil shock, because the logic doesn't change even when the headlines get louder.
Recent experience rather than extrapolation of history. And if I have an advantage over many of my peers, it's that extrapolation and the reference to arithmetic rather than rhetoric that matters.
There's some proof here because, I mean, back in the spring, you flagged Iran and Strait of Hormuz oil shock as the big kind of wild card for this year, 2026. Now, today, President called the ceasefire over. The U.S. hit Iran again. Oil's ripping about 6% the last time I checked. Is this the scenario that you've been warning about playing out even more? What are your thoughts here?
I'm not a geopolitical analyst, so I won't speak to that. I will say that I had a fear the last time that you and I talked that the conflict was irresolvable in the sense that the Iranian leadership prevailing was an existential concern for them, and it's an existential concern for the Israelis. My own personal belief is that the United States has no business there. Mr. Trump doesn't have me on a speed dial, so he doesn't consult me. For reasons that are non-financial, I'm old enough now to prefer that young people didn't die, separate in part from finance. In terms of trying to make a financial forecast, I don't know how to do it.
Yeah, but I mean, you're looking more at any oil and gas companies right now? I mean,
not as a consequence of this. I don't make decisions based on information that I can't process. I don't know what's going to happen in terms of peace or war. I am making oil investments because, as you and I discussed before, the industry is underinvesting in sustaining capital by $1 billion a day. The shortage that we experience today is artificial. It's due to war. It can be ended with an armistice. The shortage that's coming to us in 3 years is structural. and you won't be able to end it with an armistice.
Yeah. Does it ever surprise you, Rick? I mean, these headlines that we see, they act as such a volatile trigger for not only equities, but I mean, oil pricing, et cetera. I mean, ironically, gold sold off today because higher oil revives the inflation fear, and now the markets are pricing in this Fed rate hike, right? Some banks have even come out today and trimmed their forecast on gold. I mean, is this just the breather inside the bigger bull market? And do you think we're going to have a little...
I can't tell you what the market's going to do in the near term. My suspicion, and by the way, I don't invest based on my suspicions, but my suspicion, since you asked me, is that U.S. interest rates will stay nominally strong and gold will be nominally weak, perhaps for the balance of 2026. But that doesn't matter. Structurally, the dollar's toast. Not relative to the Canadian dollar, not relative to the euro, but in an absolute sense, structurally, the dollar's toast. So I'm sort of unconcerned about what happens in 2026. I got plenty of money to get me through 2026. I'm vitally concerned about what happens over the next decade.
Yeah.
As to news, I have found that too many people rely on news because it allows them to feel as opposed to think. It's easier to feel. It's easier to have your motivation be something that doesn't require you to do any work. Mercifully in my life, by the time I was 30, I learned that that was the wrong way to invest. And so I get to compete with people who handicap themselves.
That's interesting. That's interesting. And I mean, the investors on the ground at this conference, they do understand. I mean, they learn amazing things on stage here. I watched a couple of panels, and I have to ask you, because it's something that struck me this week, is Hong Kong launched its own gold clearing system, right? Singapore's building one. Even London shifted into Asian hours, which is interesting. So the East isn't buying the metal right now. It's building the machinery. So what are your thoughts on the Western investor? Just talking to the people on the room here. Is there going to be more general?
This is the wrong constituency because you're trying to extrapolate. As I say, you're asking a choir in an evangelical church if they believe in God. Likely the answer is yes. Looking at it bigger, let's look at arithmetic. The market share of precious metals and precious metals related investments relative to other savings and investment classes in the United States is 0.5%. We are as relevant to the broad economy as a pimple is to a blue whale, right. Okay? The 4-decade mean is 2%. If demand returned to mean, it would grow fourfold. In circumstances like this, reversion to mean almost always means an overshoot. But let's assume we don't get an overshoot. If demand returned to mean, if the market share of precious metals and precious metals investing in a market, the United States, that accommodates 22% of the world's savings and investment assets, were to return to mean, demand would grow fourfold.